Hey there, this is Bruce with Team Life Academy. We make this quick video for established business owners who are already making $15,000 or more per month, have good credit, and have consistent income coming in. But even though the business is doing well, you may still feel like there are blind spots in your financial system. Maybe you're paying too much in taxes. Maybe you want to acquire more real estate, creating more passive income, or build long-term wealth. But you're not sure if your current structure is set up the right way. You're thinking about how to preserve your wealth, protect your family, becoming your own bank, and creating a legacy. That is who this is for. This is not for someone who is starting a business. It is not for someone who is not ready to take action on their financial future. This is really for business owners who want to create a smarter financial system for long-term wealth. Our process is built around what we call the Epic Life system. And the first step is identifying where the biggest financial bottleneck is right now. And from there, we help you look at the full picture and build a stronger financial foundation. One of the areas we also help you understand is how to use property structure, life insurance policies to create more financial flexibility. This is where the idea of becoming your own bank comes in. Instead of always depending only on banks, credit lines, or your own personal cash, the goal is to create a system where your money can continue working for you while also giving you access to capital when those opportunities come up. We also help you understand how to leverage OPM, which is other people's money, through financial institutions. The purpose is to preserve your own capital, structure your finances properly, and use funding strategically. Today, the right policy can help you protect your family, create living benefits while you're still alive, building cash value, and support long-term wealth planning, and even become part of a larger strategy for retirement, legacy, and financial freedom. Before our meeting, we want you to have a clear understanding of how modern-day life insurance actually works, because a lot has changed over the years. In this video, we're going to walk you through the death benefit, living benefits, the history of insurance products, and how newer innovations like Vitality are going to change the way people think about coverage. We will also compare life insurance to a 401k, explain how insurance can be used as a trust-like strategy, show how index strategy make credit growth to your cash value, and break down how people can leverage insurance as a tool to build and preserve wealth. I encourage you to watch this video all the way through, because by the end, you may realize that life insurance is not just something you buy for when life ends. It can also be a powerful tool that helps you while you're living. There's a lot of information in this video. I highly encourage you to focus, take notes, remove distraction for 15 minutes, and we're really excited to meet with you soon. So at the bottom of the screen, you see a lifeline going from when we're younger to when we're older. And there are two curves that happen in our life. The first one is called the wealth curve, going from when we're younger to when we're older. We make more money, we have more savings, we build more wealth. The second one is a liability curve. The day we are born, we have a lot of future responsibility we got to pay down, right?
Yep.
We have student loan, mortgages, children, parents, credit cards, and lifestyle. And eventually, hopefully, we arrive to the right-hand side of the equation where we pay down a lot of those liabilities. Our whole house are paid off. Kids are grown up. Our parents might not be around anymore. So it's just us. So we just need a lot of asset and wealth to be comfortable.
Yep.
So typically when people buy life insurance, is on the left-hand side, where you don't have a lot of money, but you have a lot of liability that you haven't paid off yet. And on the right-hand side, you just need a lot of money to have a comfortable retirement.
Amen.
So that's originally how people been buying life insurance for hundreds of years, right?
Yep. Yeah.
And then we're upgraded to the living benefit, which is the official name is called accelerated death benefits. This is the first version of the living benefit, where you have an option to take a discounted benefit from insurance carrier, but you do have to terminate your policy afterwards. And the option that you have to choose is either chronic illness and critical illness. And you can either choose chronic credit or death benefit. You only can choose one. If you have $1 million coverage, they might offer you 300,000, 500,000. If you claim it, it's gone, right?
Yep. Yeah.
But now with John Hancock, it's very different. They have a standalone living benefit, meaning that it requires you to have a health insurance in order to sell it. But when the client is applying for the critical illness, they can get up to 250,000 with no impact to their policy, with no impact to the death benefit.
Oh, wow.
And when long-term care and chronic illness happens, it gets deducted from the death benefit, but it does not remove the death benefit. So if I have $1 million coverage, I can use $500,000 for long-term care or chronic illness. I still have a $500,000 for my kids.
Wow, interesting. Okay.
Yeah, big difference.
Yep.
So before you can get 300,000 if you claim early, now you're gonna get the $1.2 million pretty much regardless.
No matter even if you take half up front,
Yeah,
80% up front,
yeah.
they'll still okay.
Yeah,
Okay.
and your policy does not terminate, meaning you still get to
Right.
use the policy to do loans, to do savings, to do all of those things, which is
Okay.
a great benefit.
Okay. Awesome.
Now I'm going to get into a little bit of a life insurance history. So before 1980, we started with two types of policy. We have the term life and the whole life. Whole life gives you 4% interest rate, and both of these, you're not going to be able to skip payment. It's like a
Right.
mortgage.
Right.
And then in 1980, they invented a universal life. It has because at that time the market was at 13% interest rate, and people also want a more flexible way of paying their policy. So another name for universal life is the actual structure is an annual renewable term, and then plus cash value that's in an investment vehicle. And then 1986, variable universal life was invented. People can invest their money from inside the cash value directly into stocks and mutual funds. And then 1997, the insurance company sees a imminent crash coming. They're inventing a new product that has a cap and a floor. And I'll talk about a little bit later on how they're able to do that, but it's using options, to protect the upside and the downside.
Yeah.
And then 2006 is when PFA working with National Life Group to distribute this new product called Living Benefit. People are living longer, and there's a long-term care demand at that time. And
Yes.
this product become the most popular product, and PFA got really big because of that. And then, but the Living Benefit product didn't become popular until about 2016 when Hermie Bakke started coming to Hawaii and things like that.
Yep.
And finally,
I
we
got
have
it. Unbelievably, that's when I got it. So pretty crazy.
Yeah. Yeah. And then Living Benefit IUL plus the Vitality program is released back in 2015. And it's also not going to be popular until about 10 years later, which is now.
Yep.
Right?
Yep.
So the timing is it rewards people for healthy living up to 25% lower cost of insurance. It's a huge cost saving for anybody that gets a policy with Vitality. And how they're able to create a Vitality is, I'm not sure if you watched the video, but they were doing studies in South Africa for like 30 years. They were able to identify 4 things that makes people live longer: no smoking, no drinking, exercise, and eat healthy. But they were able to track a really good statistic, and they come up with a new mortality table. And with the new mortality table, they're basically allowed by the federal regulation to charge a lower rate. So that gives them an inherent advantage when compete in the market space.
Now, before we get into the next point, I want to quickly share what we are building inside the Epic Life membership. Epic Life was created to help business owners get connected to the right tools, the right resources, and strategies so they can stop trying to figure everything out alone. So far, we have helped business owners understand their financial position more clearly, improve their credit profile, and get better prepared to apply for funding. We have already helped over 60 members working on their credit so they could position themselves better for business funding, access better opportunities, start building with more leverage, because capital is not just about getting more money, it is about creating options. Option to hire, option to invest, option to grow, option to protect yourself when business get tight. That is what Epic Life is designed to help business owners to do: build more strategies, more structure, and more leverage. Now let's get back to the video.
And now let's talk a little bit about the program itself. So every single policy is going to come with a digital device to pick from. You can get Oura Ring, you can get Apple Watch, you can get Fitbit, bunch of different devices. Some are free, and some you have to some they give you discount for it, but you can use whatever to track. But you're going to track your steps. It's going to track how many calories you burn, how many hours you sleep. Also, you go to doctors and things like that. So all of those things would reward you with points, which you see at the top right hand corner.
Okay.
Every single year this refreshes and you accumulate your points, and the more points you accumulate, the lower the cost of insurance will become. Silver is a 5% lower cost of insurance, gold is 10%, diamond is 15%. And this cost of insurance reduction is credited directly inside your cash value. So they're actually adding money inside your account.
Oh, that's
Yeah,
amazing. Okay. Okay.
yeah. And then you can also exchange the points for Expedia Travel, 1,500 a year, Amazon Prime membership, gym memberships, $600 grocery every year, Apple gift cards, and all of these different gift cards, as long people are actively taking care of their health.
Right. Okay.
Yeah, so this is pretty cool. And if you look at in the monetary or dollar value, you can
Right.
get, now there's more benefit now. So you're getting close to 4,000 in benefit, even if you have a policy that's 200 a month.
Okay. Okay.
Yeah. And this is kind of like the rewards that's been adding on over time. And Gallery is actually the last product that they added in terms of the benefit. This is $1,000 multi-cancer early detection test, and you can do it
Wow.
every single year. They'll ship a little box to you. You're gonna take it to your doctor. The doctor is gonna pull out a vial of your blood, and with
Okay.
that vial of blood, they can detect for DNA signal of dying cancer cell. Anytime there's a cell dying, they drop those DNA signal, and this test will pick it up. It can detect 50 different cancers and it can tell you exactly where it's located in your body, and
Wow.
sometimes even at stage 0. And there are people that I know that took the test and found out they had cancer 6 months before their doctor could find it. And they were able to get it removed without doing chemo. So
Wow.
that's, yeah. So look at the return on investment. This is how I want people to look at it, right? This is $1 million policy, 30-year-old paying until 65. The total amount of money that they put in their policy, about 150,000, and they're going to get interest rate over time. But at the
Yep.
same time, you look at the benefit you're getting on the back end. You're looking at what you're leveraging against what you're going to get. And the green bar, you can either put it in the bank, you can put it in investment, right? 401k, crypto, whatever, but it's just a vehicle for you to park your money, and then different vehicle have different perks.
Yep.
It doesn't change. You don't lose that money, essentially.
Real quick, if you're a business owner and you want to learn how to use the leverage the way the top 1% think about it, go to our website and get the top 1% wealth leverage playbook. Because capital is not just about money. Capital gives you options. It gives you the ability to hire before you're overwhelmed, invest before the opportunity passes, build system before your business break, and move faster without carrying everything on your own back. Most business owners are stuck because they're trying to grow only with their own cash, effort, and time. But when you understand how to use capital, credit, financial infrastructure, and strategic relationship the right way, you stop building from survival and you start building from leverage. That is what the playbook is designed to show you. It will help you start thinking about how to build with more options, more strategy, and more control, not just more stress. Now let's get back to the video.
Okay.
This part is really important, especially people that's nowadays, right? But let's talk a little bit about tax defer. So the
Yep.
first implementation of 401k plan was 1978. In 1980, Ronald Reagan was elected, and over his 8 years in office, he was able to reduce the top income tax bracket from 70% to 30%. And this is really interesting because the purpose of the 401k was for people to put their money inside the 401k and pull it out later at a lower bracket.
Yep.
And it was designed for people with high bracket, which is the CEO and executive of the company. Now, this is a non-discriminatory plan, meaning they got to get more people on it in order for the CEO and executive to also get elected for 401k.
Right.
So the plan that they came up with, let's turn this into a supplemental retirement account for our employees.
Mhm.
So all the employee buys into 401k, they do the matching, they get the write-off, and then now the executive get to save 30, 40% taxes because of the 401k. That was the original purpose. Now, things are changing. When Social Security began in 1935, our life expectancy was 65. Now our life expectancy is 20 years longer now.
Yep.
So by 2031, the youngest boomer would have reached the age of 67. Our tax bracket has been increasing in order to take care of this 25% aging population.
Right.
Now, because of that, in the future, when people are pulling money out of the 401k, they might be pulling it out at a higher tax bracket because of that.
Yep.
So we have to be very careful. And this is Vanguard, one of the top 3 401k company. And this is their internal statistic. They're looking at the average balance of people's 401k, the age range, and the median balance. If you look at the age between 45 to 65,
you look at the average, it seems pretty healthy, 140,000 to 200 plus in the retirement. This is including the billionaires, right? But now if we remove the billionaires, you look at the majority of the people, they have 50,000 to 70,000 in their retirement account. So to me, this just tells me 401k was a failed experiment.
Yeah. No, exactly. I agree. Yeah.
Yeah. So a lot of people really need to know what really happened instead of just blindly go into these financial products without understanding it.
Yeah.
Now, life insurance is also a very powerful form of a trust, and there's two ways to structure it. The first one is called irrevocable trust.
Yeah.
You get to you basically lock in who the owner, who the beneficiary, and who control the cash value. And that means it's outside of your estate, the creditor can't touch it, no lawsuit, no divorce, no IRS can go after it because it's also backed up by state laws, okay? And then you have the revocable version, which most of us have, is you still can control the policy, you can change the owner, change the beneficiary, change who control the cash value. You still have a lot of legal protection, it's just not as much as if you put it into an irrevocable.
Yeah.
Yeah. With proper LLC setup, it's still going to be fine. Now, let's take a look at index strategy. I think all of us are kind of familiar with it. And I do want to go into the nitty gritty as far as how they were able to create the index strategy.
Okay.
So index strategy is you put the money inside your cash value, and then the cash value is going to grow based on the mutual fund, also this index strategy. So let's say today I want to buy S&P 500. In the S&P 500, I want to put in $100. I'm buying the shares at $100, but what I'm also going to do is I'm also going to buy $20 worth of options, $10 to protect my upside, $10 to protect my downside.
Okay.
So let's say fast forward 1 month from now, the market goes up 20%, as you see in the chart over here. I'm going to say, okay, I already protected my upside. Let me exercise my $10 option. I'm going to get to buy more shares at $100 because that's the option I purchased. So I'll buy more shares at $100, which allow me to push my return to 30%. Okay, so that's one way of doing it. The second way of doing it is the market crashed today. My $100 share went to $70. I'm like, oh, shoot. Let me go back in time and sell my share at $100 because I already bought the $10 option. Allow me to travel back in time to sell my shares. So that's how they're able to create the index strategy.
Okay.
Yeah. So in the real market, the cash value looks like the blue line, and the cash value looks like the blue line, and the stock market look like the red line, right? And most people don't see the significance when it comes to the difference, but there's a way to look at this. Is number one, you can take a loan against your life insurance policy surrender value in a bad year and are able to purchase other asset at a discount, meaning that if my money didn't crash, I can loan my $100 out. I get to buy the stock at $70.
Yeah.
But my account is still at $100 because I loaned against it. I didn't withdraw. So when the market bounced back, my $100 is going to go to 130. My $70 stock is going to go to 130 as well.
Yeah.
So I'm double dipping, right? I'm getting my cash value growth. I'm also getting my stock or real estate investment growth. So that's a really powerful way for us to really compound our return during bad years.
Yes.
And now let's put all of that together, all the slides, all the information into one strategy, and then apply that. It's called Internal Revenue Code 7702, tax-free loan provision. And let's say we need $200,000 down payment to do a fix and flip rental. We got to buy this asset, fix it up a little bit, rent it out for passive income.
Okay.
Now I got a $3 million Vitality policy, accumulated $300,000 cash value at 8% interest rate. And that's actually the average for the past 14 years, which is pretty incredible.
Yeah.
So I'm going to go to an insurance company. Now I'm going to get my $200,000 out against my cash value. I'm going to get a $200,000 loan at 5% interest. And they have a fixed loan at 3% too. So you don't need to do the 5%.
Yep.
So the 5% allow you to continue to get growth from your 8%. So on paper, this is what it looks like. So the 300,000 continue to grow at 8%. The $200,000 loan does not need to be paid back. And when the insurer dies, the 200,000 plus interest gets deducted from the $3 million death benefit instead. So this completes, all the puzzle piece on how we're utilizing the insurance. And In my opinion, the best way to do this is using OPM to do this.
The next step is to book a call with us. And on that call, we will learn more about your business, your income, your credit, and your current financial structure, and what you're trying to do long term. Then we will show you whether the Epic Life system is the right fit for your situation. Click the link attached to this video and book your strategy call, and I'll talk to you soon.